All right. Hello, everyone. And we're here today with the awesome folks from Zacks Investment Management. We've got Brian Mulberry, James Ives from Zacks on the call. And we are super stoked. We're super excited. This is a big milestone for us selfishly, getting to the point where we've got some big names like Zacks coming onto our platform, which for our advisors, our advisor network, this is a really, really huge upgrade. Up to this point, up until the end of 2025, early 2026, our proprietary strategies were the only strategies available to the advisors that we worked with. And now we're bringing on firms such as Zacks, and everybody's extremely excited. So super stoked again to have Brian and James on, and we're going to dive in, have a real open discussion today, kind of podcast style, and get into the weeds on markets and everything else. But why don't we start with James and Brian? You want to tell us just a little bit about yourselves? I think everybody knows Zacks for the most part. You're welcome to throw something in on Zacks, but you're a really well-known name. But tell us a little bit about what you do for Zacks.
Absolutely. Brian, you want to kick it off?
Yeah, sure. We're absolutely excited to be here. Zacks has been around for almost 50 years. We go back to the late 70s. Leonard Zacks started Zacks Investment Research with one premise. He was trying to find what the most predictive factor for the future price of a stock is. And what he landed in was earnings estimate revisions. So where we are today is Zacks now has the ability to re-rate and re-rank every traded stock every day based on the next 2 years worth of earnings estimate revisions. So we go out into the future, quarter by quarter, 8 quarters, and look at what industry analysts are saying about every publicly traded stock. It's roughly 3,500 analysts and about 8,000 stocks that we go through every single day. I like to think of it as like the Matrix. All of this data is just crawling in the background, and it's our job to look through that and find the buying signals, look for really good opportunities, high quality balance sheets in every corner of the market. And it gives us also the other side of the data, which is where not to invest, where you start to see weakness is developing in terms of declining revenues, declining profitability, sometimes just individual stock by stock, but also sometimes sector by sector, depending on what market forces are happening in terms of interest rates and other things that we might talk about today. So that's where we start our day every single day. And then from there, we just try and manage as much risk as we possibly can out of the portfolio that we're trying to develop. So it's a very exciting time to be in the markets right now. It's right up our alley to be able to parse what's working, what's not, what we think is going to be good a year from now versus where we came from. We have the data to back it up. And the best part of my job is proof is always in the pudding. Our products go back more than 30 years with a real track record of history. The longer you look at them, the better they get. What you find is we own real companies with real profitability over a long period of time, and they hold up. And that's really what we're built to do at any moment in the market, no matter what's happening. So that's just a little bit about us. My role as the client portfolio manager is I'm kind of the non-voting member of the investment committee. I don't run any of the strategies so that I am available for meetings like this. James is our national accounts representative and kind of your first point of contact. He can always get a hold of me if there's any questions about the market, about what's happening. We're more than happy to participate. We feel like we have a ton of information that we can offer about what's happening, so that if you have concerned clients about what's going on, we will give you all the information that you need to be able to talk about the equity markets in a real way. That's what we're built to do day in and day out.
That's awesome. And the proof's in the pudding. You've got a lot of great performance history to show.
Yes, absolutely.
Love it. James, anything you'd like to add? Tell us a little bit about yourself.
Yeah, no, Brian hit the nail on the head with the Zacks intro. So I'm James Fives, and we're first of all excited to be working with you guys and partnering with you all and potentially working with some of these advisors in the future. So I'm really optimistic on this opportunity here. And thanks again for hosting us on the call today. A little background on me: I oversee our platform partnerships here at Zacks Investment Management. So working with the different institutions, the CIOs various different TAMP platforms, and managing these relationships, and getting our product onboarded, and working with teams like Revisor to get integrated, and allow accessibility for the end user and the end advisor. So that's a little bit of background on my day-to-day role. Today, specifically, I can cover a couple housekeeping items from an accessibility standpoint within the Revisor platform before we kind of dive into the more podcast style discussion with Brian here. But today, we have over 25 billion in AUM. We cover a wide range of investment strategies and equities universe across multiple different vehicles, ranging from SMAs to active ETFs to model portfolios, many of which are available to you through the Revisor investment portal. So we'll cover more specifics on these throughout the conversations, but just so you guys can know, we do cast a very wide net within the equity space. Available to you today through Revisor, we offer 3 different types of suites. We have an SMA suite, so 5 SMAs ranging from all cap to a large cap growth, a large cap value, a mid cap, and a small cap, all rank in the top 7% of their Morningstar peer groups. The cumulative platform and management fee across these is 43 basis points. More info on these is located in the sleeve fact sheet file in your Revisor portal under Zacks Investment Management. The second tier of portfolio offerings is our active ETF model portfolios. So think of these as more of a smaller account size solution where we're pairing Zacks actively managed ETFs with third-party passive ETFs to create a multi-asset class solution consisting of about 10 to 15 ETFs. Those are available to you through the platform at a 12 basis point fee. Again, more info on those can be found in the Revisor portal under portfolio fact sheets under ETF model portfolios. And then lastly, we have kind of a newer offering to the marketplace. It's our hybrid portfolio solution. We call it Zacks Plus. And what it is, we pair, again, our actively managed ETFs with an SMA sleeve to form a holistic and cost-efficient solution. So great mid-size account solutions that offer broad range of diversification with single security ownership, really built for scale. So you're going to get 30 to 75 holdings within each of those portfolios. There's 7 different portfolios to choose from, and really you're able to implement those at scale, and really focus on growing your book of business and allowing us to do the back end management. So that's just a little bit about the offering we have available to you. So I'll hand it off back to you, Landon, to continue the conversation here.
That was great, brother. I've got a couple of little details I wanted to ask you about with Zacks Plus. Before that, though, let's introduce Ethan and Nick. Ethan and Nick from the Revisor team. Ethan's our chief investment officer, wicked sharp young man, been with us for about 10 years. He's a CFA. Then Nick Cargill joined us 3.5 years ago, roughly, and he just took level 3 of the CFA exam. We hope that I'm pretty sure that he passed. He passed the other 2 at one try. So really sharp young gentleman here on our team. We love working together. I know Nick and Ethan, if you got anything you want to throw in, feel free. But
yeah, thanks, Landon. Just excited to be here. Excited to have the discussion today and talk markets a little bit more.
All right, love it. Awesome. So James, real quick. So our audience, like I watched, Brian, I watched a bunch of your interviews on CNBC and whatnot, which I enjoyed all of them. And I know a lot of times the audience there is just like, let's say the public retail investor, not that financial advisors aren't, watching as well, but our audience is really, the financial advisor, the go-between between us and the retail investor. And we've got a lot of advisors on the call today, and that will be the audience where we push this out, and that's where we get where we put a majority of our attention. And so when I look at something like Zacks Plus, and the way I'm unpacking it, I want to make sure I've got this right. The way it looks to me is we've got some economies of scale working, where we've got some Zacks proprietary investments that are part of those models, which most of us would not have any beef with, right? That would be not a negative thing. If you were just real big picture, talking about the economics there, if I'm understanding it correctly, because this is fairly, Zacks Plus is fairly new to me as well. I've been familiar with the Zacks names, for many, many years. But is it fair to say that we've got some very attractively priced ETFs that make up that are in this portfolio? That's where Zacks gets some compensation, and then the overall overarching fee for the model itself is reduced down to a fairly low level compared to our other options. Is that a fair way of putting it?
Yeah, that's exactly it, Landon. And kind of the thought process behind this was to offer clients a really cost efficient solution where they're able to own SMAs, but not at an SMA price point, and really that individual security ownership that we're able to implement here and deploy into the 7 risk-based models that we have has really gained traction. It's something that's newer to the marketplace that not a lot of other firms are doing right now, and we've really gained a lot of traction across our platform partnerships, and we're really excited to be offering it to you all as well.
Yep, awesome. I love it. So for the advisors listening now and in the future, it's similar to we get an example would be BlackRock. Okay, so BlackRock offers up their ETF models. Essentially, hey, here's some model portfolios that you can follow. And we know a decent number of RIAs that don't have a really robust, let's say, investment process. They don't have a very robust team, if you will. And so they essentially, go into the BlackRock system and kind of mimic their models, and those become their models, but they have to use BlackRock ETFs. So from BlackRock's perspective, they've got flows coming into their ETFs. It solves some problems, not for a large percentage of RIAs, but when I looked at your Zacks Plus model and looked at just how you put everything together there, I was really impressed with it, because at the end of the day, we're all, we're looking for net of fee results that are very nice. We're trying to create alpha for the client base. And as we know, the higher the fee goes up when we've got a 2% or a 3% hurdle to overcome, it makes it pretty difficult to actually provide some net alpha over time. So I was just really impressed with that, just kind of the mindset and the understanding of what a lot of advisors are looking for their client base when y'all built that. So really looking forward to having that available to the advisors. For the advisors listening, just a real quick housekeeping item. This is extremely easy to implement. So in the past, you've only, let's say, had our proprietary strategies available. It's no harder or easier than what you've done in the past. We just have these Zacks portfolios available to deploy at any time at a really, really nice cost point, with no complication, confusion, or any no additional work compared to what you've seen in the past. So very, very seamless process, easy to implement. And after we talk today and you're interested, just reach out to our team and let us know, and we can get you started. But why don't we, one of the topics, kind of our pre-podcast conversation last week, we were digging into, value making a comeback in 2026, and just everything going on in markets. And I know everybody on the call would really, we've got some investment experts here today that everybody respects. So we'd love to dive in and start having some dialogue there. So why don't we start with I was looking at some numbers Nick sent me earlier. If I see right, like our Dividend Aristocrat portfolio is up almost 10% for the year, which is, representing value. And I think, growth is essentially, market as a whole, growth is flat. So why don't we start there, Brian or James, whoever wants to pop in and tell us your thoughts and where we're at, where we're going.
Yeah, absolutely. So we are midway through the first quarter, and that everything you just explained, Landon, is exactly correct. Over the last 45 days, if I go back another 45 days and look at a 90-day chunk, large cap growth is down about 6.5%. Large cap value is up 9.5%. So this is something that has been in transition, but for more than just the year-to-date period, if you will. So there's no question about it. What's happening? What's driving this rotation? Investors are finally starting to see AI in a little bit more of a realistic way. the last 3 years, you've got the S&P 500 up 80-ish% over 3 years, driven on the heels of roughly, the Mag 7 plus a few other names. If you add in Oracle, Broadcom, and Palantir, you now have 10 stocks that account for 40% of the market cap of the S&P 500. The performance of those 10 names over the last 3 years is where you're getting the energy and the momentum over that period of time. These companies are now committing to trillions of dollars worth of capital expenditures to try and grow AI infrastructure. The limiting factor to AI right now is compute and computing power. And so they're building hundreds of data centers across the board. What's finally happening is, rather than investors just being excited to see more and more money being spent by Amazon, Microsoft, Meta, and all of these names, they're coming to the conclusion that at some point this money has to come back to those companies in terms of revenue, and how is this going to actually get driven by AI? Our biggest question is, will that revenue that comes back to the balance sheet actually be profitable at this point in time? So what you're seeing is people are just simply following where the money is going. $2 trillion between last year, this year, and next year is where you're seeing the real pop in the market, but it's starting to translate into some of these cyclically value sectors like industrials, manufacturing, durables. Caterpillar and John Deere are two of the top performing names in our dividend strategy that are doing incredibly well, up roughly 30% on a year-to-date basis, because these are the types of companies that will be implementing the build out of these AI data centers. So if you're going to build 100 of them, they're awfully big. You're going to have to move a lot of dirt, right? So this is just where things start to flow. And that's what we're finding as a macro theme that's influencing this last 90-day period right now.
Got it. Did you hear Elon Musk, by the way, talking about the data centers being in space? Have you heard that conversation?
Yeah, there's no community pushback there. There's a lot of NIMBY, right, which is not in my backyard kind of a thing. I don't want to pay higher for utilities. I don't want that thing, buzzing around my children. I mean, the joke that we had in Northeast Ohio when I grew up was, did you grow up underneath some power lines or something, right? So nobody wants that in their backyard. So I think he's certainly onto something. He's the guy that invented reusable rocket boosters. So am I going to bet against him? No, probably not. But it's also not something that's going to happen tomorrow either.
Yeah, and you brought up an awesome point with Caterpillar and John Deere, and I hear Nick and Ethan talking about this a lot. But there's so many companies in the periphery that are involved in it. So everybody's focus point is on the Gemini platform, the fill in the blank Anthropic and ChatGPT and OpenAI, everybody that's out there that's really known for being in the AI space. But all of the other benefactors that can come into play as this gets built out, it's an interesting thought. But the thing that you mentioned a second ago that I'd love to hear some more, just some additional feedback, just the monetizing profitability. My brain just can't swallow it all up when I hear about the amount of expenditures going out to build the platform. Do you feel like we're going to end up in a space where, like in the Mag 7 example, do we end up with such tight monopolized type of ownership of AI, or does it go the opposite direction, and do we end up with a huge number of smaller companies that are in the space, or do we just have, let's say, two? Where do you see this going long term from that perspective?
Yeah, absolutely. At the moment, there's not really a monopoly other than NVIDIA owning what is the most valuable computing, franchise, if you will. The GPUs that they offer are built in such a way that they are the highest performing, most complex processing units that you can get to try and build your AI stack on. There's no question about that. So what does that mean? They're the best at training new models so that the next version of ChatGPT or Gemini or Grok or whatever it is can learn faster and do more things. So that would be, kind of the starting point. Is there competition for NVIDIA? Yeah, you bet. As a matter of fact, Google is using their own TPUs, the tensor processing unit, to build their own stack independent of NVIDIA to prove their case that you can still do it without them. So there's competition on the hardware side right now. One of the biggest things is, how are you going to run these without melting them, right? The biggest problem in building data centers is you have to cool down these giant stacks of computers so that you don't melt all of this valuable hardware that you just bought. The TPUs use less power than the NVIDIA GPUs, so they need less cooling. NVIDIA has fought back with their latest offering saying, well, you can cool it with liquid, not air. It's more efficient. It's less expensive, liquid cooled versus air cooled. So you see all these different avenues that are out there that are just on the adjacent side of the AI itself that provide investable opportunities. So to answer your question directly, no clear winner, lots of competition, and there's across the spectrum of scale, more competition for the AI development, right? So we see smaller companies looking to compete with different methodologies, but at the end of the day, the scale of revenue that you generate from your product is going to matter the most. Who can generate the most revenue? Who can have the most adoption of whatever their product looks like at this point in time? That still gives an edge to the larger companies in the space right now, but we are starting to see competition heat up.
I got one more kind of nerdy question in that realm that I'd love to ask you. I'm not sure if you're going to have an answer for me or not. After that, I'd love to get into how Zacks portfolios kind of implement the needed diversification. We see a lot of advisors that like to chase returns, right? So we have advisors, we're talking on the phone all the time. They want us to move them out of value and into growth, and we have to have this conversation with them, which now we can say, hey, by the way, we were talking about this a year ago, and now you can actually see this come to life. So I'd like to go down that path here in a second, but I have this. For whatever reason, I fell in love with quantum physics about a decade ago. I don't know why. I watched a video on the double slit experiment, and then it got into like quantum entanglement and all these weird concepts that I didn't know our reality worked in that way, and so I've really kind of delved into that world a lot just on free recreational time. And one of the things that always that goes through my mind a lot is there's a dude at MIT, I think he's at MIT, his name is Max Tegmark. And Max basically was presenting this, he was trying to teach everyone on this call this concept that a quantum computer, and that's where my question comes in, is about quantum computing tied into to AI. And he's describing the way a simulation works and is built in the 2D world coming from silicon-based computing technology. And then he goes down this path and he's explaining what a simulation would be like if it was created by a quantum computer. And basically the answer is it's a 3D simulation like the reality frame that we live in now. And I hear him describing this and my brain just goes absolutely haywire. So my question for you with that background is, what are your thoughts, if any, on where quantum computing comes into play in the AI world, and how do they potentially mesh together into one thing that changes our future drastically?
It's a fantastic question, and it comes down to the line of what is investable and what's not. Quantum computing is real, and I'll explain the difference. And that is, in the digital world, you just have ones and zeros, right? And so when you're looking at the large language models, ChatGPT, Grok, Gemini, they are processing and training out to the 32nd decimal point. Still just ones and zeros, but they're out to the 32nd decimal point to try and be as exact in their processing power as they possibly can. So the gains in traditional AI are still in the digital world based off of ones and zeros, but a lot of them, right? The quantum computing state means that it is, like you said, Landon, 3D. These are qubits that are paired in fours, 4 ones and zeros, but the difference being a 1 is never always a 1. It can switch back and forth between a 1 or a 0 at any one point in time. So you now automatically speed up the processing by 4 times. That's where the quantum comes in, right? The thing is, maintaining that quantum state in a qubit is very tricky. And it's something that has to be done in the physical world, usually with lasers and things of that sort, to try and excite an atom to a point where you can get to this qubit type of a state. Now, you can tie qubits together. I'm aware of the study that you're talking about at MIT. There's also one in Stanford where they've been able to reliably or sustainably create a quantum state of 8 qubits and maybe 12. The most you could get to is 128. But the theory being, if you were to get to 128 qubits all tied together, it would be so fast, it could consume every byte of data in the known universe in less than 5 minutes.
Wow.
So think about every word in every encyclopedia, everything ever recorded in a digital state, it could consume all of it in 5 minutes. So that's like a lot of horsepower when it comes to data and chewing through it. Now, once it consumes that, can it process it and spit something back out the way that large language models are? The answer would be the combination of AI programming and being generative, meaning thinking on its own and making decisions on its own and things of that nature. That's where you start to see these really pie in the sky type of projections and things of that nature. Is it possible? Yes. Is it probable? No, because they simply haven't been able to maintain or sustain that quantum state. The issue scientifically is these qubits can switch back and forth between ones and zeros, but if you try and catch them to measure its rate, every time you peek in on them, it disappears. You break the state.
Yep.
So you just simply, it's one of those things, they're going to have to prove it by just believing it's there and holding it in a state long enough that everybody else believes it too. Because every time you try and stop it and measure it, it goes away. So that's
the same issue with cooling, right? We have the same issue with quantum
Yeah.
computers as we do with the data centers. We have to keep them cooled down.
burning that fast, which again is one of those arguments for data centers in space, because it's pretty cold in space. You don't have to worry about it, right? So it's one of those things that's out there. The technology is real. And I would say to a large extent, generative AI is in the same posture, right? We are aware of self-driving cars, right? Waymo exists. Tesla has robotaxi, they exist, but they are not at scale to a point where it's a profitable business. There are some hurdles out there, one being a trust factor, right? The adoption rate is growing. People are getting more comfortable with it, but there has to be also a positive safety record to get regulatory approval, which is what's stifling a lot of the generative AI that's out there. Robots, right? They're there. I saw a video yesterday that my daughter was showing me about these Chinese robots doing kung fu and that kind of stuff. They exist. They're out there. There's no question about it. Are they going to take over every manufacturing job tomorrow? No. Again, we're just not there at scale. So if in your investment thesis, you want to keep track of these businesses to see where the innovation is coming from, but that product development has to then lead to something that solves a problem at scale to generate revenue to become a reliable business, right? So that's where we are in this moment. In the last several weeks, we've had some wild shifts in the market where like software is dead. All of these SaaS companies are just going away because Claude created its own social network for AI bots to hang out and talk to each other. Again, not at a scale. I've heard some stories about people using AI bots as personal assistants that have been pretty effective, right? In order to move that out into what we do, think about our business and how we deal with clients. If you were going to try and generate an AI bot to help you with your own business and be a financial advisor or an investment manager like us, you have to open up your entire database, all of your portfolio holdings, all of your contacts, where all the assets are held, and then let this AI go through everything to provide the most efficient model. There's no way FINRA or the SEC is going to be okay with that in this moment in time. It doesn't make sense. So the only way you can do it is to pull it in-house. That means on-premise data management, which means you need storage. So one of the things that happened in the last couple of weeks, a couple of Thursdays ago, was all of these memory stocks like Western Digital and all that kind of stuff were going bananas. And we saw the traditional software makers going down because now everybody's going to have to buy memory chips to keep all of their data on hand, because now I can't have AI outside of the building and all of that kind of stuff. Okay, again, a timeout here. Will some of that work? Yes, for some people. Will it work for everybody? No. So there's not enough scale there to shift our thinking that Microsoft as a company and a business model is dead and dying. That's just not true, right? Amazon AWS is not going anywhere. They provide a service at scale that gives them a pricing opportunity to still go out and win business on an enterprise valuation, which is why when you start to see some of these dislocations in the stock market and the pricing, my boss, Mitch Zacks, calls these anomalies, where there's still really good stocks that get pushed down by sentiment, not by fundamentals. And it creates an opportunity for us as an investor to go out and see those things in real time. So understanding the macro environment and how this is all going to fit together, matching it up with the real earnings power, again, the real profitability of these products going forward, is how we're going to navigate from where we are now to what happens next.
I love it. So would it be safe to say that we've got a bunch of unknowns, but this era we're going into now, the AI quantum computing zone, to me it feels, and I don't know if anybody knows for sure, it feels significantly more shifting and impactful than the dot-com era, than the internet emerging as a whole, at least as momentous of a time. So would it be safe to say, as an investment manager, that with all of this stuff coming down the pipeline, that we just need to do a good job of putting our clients in a position where they can take advantage of these high growth potential spaces? And it's I would say brings us to the topic of conversation today, which is having a great money manager like Zacks that can bring that stuff to life and make sure that our clients end up in a position where they get great, let's say, risk-adjusted returns on their portfolio.
Absolutely. And the biggest key to doing exactly that, I mean, you're hiring us to be 100% invested 100% of the time. That's what we're going to do. We don't use cash as an asset class. That is just a punk move in our view. You've got to stay invested. You're hiring us, you're paying us fees to do this type of work. So we're going to be fully invested all of the time. Now, the question is, can we do that and manage risk in a specific way? And we feel like, yes, we absolutely can. Are there some parables to the dot-com bubble? Yeah, I think so. Some of the vendor financing that happened in the late 90s, when you think about a company like Lucent Technology that was really, really big on laying fiber optic cable because broadband internet access was going to be the biggest thing ever. Everybody was going to want to have internet access and do all this stuff. Does that sound a little bit like AI? Yeah, it does. The problem is they overbuilt their network and they outkicked their coverage by about 10 years. So the demand for that type of broadband access came around eventually, but instead of being in 95 and 96 when they were building it and financing it, it came around in 2005, 2006, when more people had more access to a home computer that could actually process at that speed. That's where we're a little bit different. Everybody has access now, even anything like this, where you can pull up AI and use it. So the adoption rate is faster, so that curve bends higher. Now, again, where is that going to happen in terms of profitability? NVIDIA is financing a lot of these companies on the software side to buy their own hardware. That sounds kind of rhymes with what Lucent was doing, but at the same time, they're still driving an enormously profitable business, right? So that's not their only thing. They're actually going out and taking equity positions in some of these partnerships, hedging some of their bets, all of that kind of stuff. So it's a little bit different. The other thing is, in the full backdrop, most of the dot-com companies that were out there in 98 and 99 were unprofitable. It was all just rage and very strong positive vibes and momentum. Right now, we don't have a lot of unprofitable companies. There are some, no doubt about it, but most of the unprofitable ones that are in the very early stages are held in private equity right now. That's actually a nice insulating factor for the stock market today. Most of the bad stuff that might collapse isn't publicly traded right now. It does roll up in some of your private credit offerings that might be a little bit more risky than you might think when you're dealing with some of those types of issues. But on the equity side, we have a lot of this stuff priced into where the market is, and the volatility is just the change in sentiment, right? I'll put a very fine point to it. how we view the market today. We're at 6,900 on the S&P right now. Anytime we're at 6,900 points or more, this market is trading at 23 times its current earnings of about $300 to $305 a share on the S&P. The long-term historical average going back 75, 80 years, it should be 16 or 17 times earnings. The equal weight S&P is trading at 18 times earnings. So that gap of 5 points between 18, the equal weight, and the current 23 on the market cap S&P is all AI momentum. So if that momentum fades and the market becomes distrustful of it or something changes, then we simply have a pretty run-of-the-mill 17, 18, 19% correction in front of us to get that PE from 23 down to where the rest of the market is at roughly 18. Guys, that happened a year ago. That happened April 9th, right? So that would be a pretty normal, pretty healthy type of correction. Some people might call it a washout, but we're trading at a very high valuation based on all of the things that we've been talking about today, what AI could do and is helping to grow earnings in certain places, but it's not doing it on the generative side yet. It's not doing it on its own. And so you just simply have to be paying very close attention to what quality means to you. For us, quality is cash flow. You can fake a balance sheet, but you can't fake free cash flow. Free cash flow means you're going to drive earnings positive. That's where we want to be in a moment like this.
I love it. And how would you, so if now we kind of shift back to the Zacks portfolios, this, the way I view it is we have felt a lot of, I don't know if pressure is the right word, but basically, and whether it's retail clients, because we have a retail client base here in Northeast Ohio that I still, spend 10, 12 hours a week in that practice. Ethan and Nick are involved with some of that's not where we spend the majority of our time, but we get to see that side with the retail investor as well. And so we get some pressure, if you will, sometimes from that retail space where they look at certain parts of their portfolio. They might not even know how to describe it, but they're basically saying, hey, this value stuff, no good. Growth stuff, great. Let's move some more over there. How would you describe, just in general, the construction of Zacks portfolios to take advantage of these things and just have a great diversified portfolio that can grow nicely over time and meet the client's objectives without trying to chase these things around? And most of the time, what our experience has been is end up with a negative result when trying to do those types of things.
Yeah, it's Warren Buffett was right all along. It's not timing the market, it's time in the market, right? And so for us, using that as kind of a starting point, along with our core belief about earnings being the lifeblood of the future growth of your stock price, we can take something like NVIDIA and look at it in this really large cap growth bucket where it is today, but it's going through its own transition process to becoming a value play. At its core, NVIDIA is just a manufacturer, right? They make stuff. They're not really an AI technology company. They build the nuts and bolts that AI runs on, right? That's really where they are. And what you've seen is over the last 5 years, their free cash flow looks like this. Guess what? Their stock price looks like this, right? Because they've been growing revenue and earnings at this triple-digit rate over the last 5 years. But we're getting to a point now where that starts to curve and level off like that. So when the rate of growth starts to cool, so does the momentum in the stock price. Now, they may still be the best engineers with the best product or the best solution for AI to run on in the next 3 to 5 years. All we're simply saying is there comes a moment where their ability to grow by 100%, which means they're doubling year over year over year, that starts to slow down. In fact, what we see is in the next year, revenue growth is 25 to 28%. The year after that, it's more like 15, and then eventually it becomes 10 or 12. And where you end up with is everybody wants to be Walmart, right? Walmart generates $200 billion every 90 days in revenue. They're gigantic. If they want to grow by 10%, they got to find an extra 20 billion a quarter in order to be able to do that. Well, that's where you're finding NVIDIA moving towards that moment where they just become really, really good at managing the revenue that stops growing by triple digits over time. So then we can dig into subsets of factors to look at what does that transition look like? How much of NVIDIA should I be owning now versus how much did I before? And that kind of stuff. So it's not just my nominal rate of growth versus the market, it's your relative growth rate versus your peers and what everybody else is doing as well. And we do that very systematically. We have an optimization process that runs across all of our products that helps measure that growth rate, not just against the benchmark, but inside each individual sector. What are these companies really doing? It helps us really pick what we think are the leaders and avoid the laggards in that type of a moment, sector by sector, stock by stock.
Love it. So we've got Zacks SMAs, we've got Zacks ETFs, we've got wonderful portfolios with folks like you that are behind the scenes that are making decisions with the names in the portfolio, taking all these things into account. It's super exciting. I know we've got a bunch of people on the call, and there might be some questions. I haven't seen any come through yet, but I don't even know if I have visibility into that. But I wanted to see if either of the really smart guys, Nick or Ethan, you got anything going on in your brain that you would like to ask Brian as we were conversating there about everything under the sun?
Yeah, I had one question that was coming to mind for you, Brian, with the shift that's going on right now and the potential mean reversion that you talked about with the high valued stocks and the rest of the S&P. Are there any particular sectors that you're looking at that you're favoring if you had to pick maybe 2 or 3 at Zacks?
Yeah, I really do believe that there's a lot of potential in the cyclically value sectors. So durables, staples, and financials are where you're going to find a lot of positive energy from where we are right now. Financials are probably the most attractive at this point, just from a valuation perspective. They've gotten beaten up a little bit over the last couple of weeks. Again, some of this rumor and energy around AI is going to be able to do all your banking for you and all of that kind of stuff. Again, we're just not buying the hype there. When you look at what's on the macro side of influences and where some of this thesis comes from, the back half of the year should encapsulate more rate cuts from the Fed, but not necessarily on the short end of the yield curve. The real boost is going to come from getting the long end of the yield curve down. We've had 6 rate cuts already. The 10-year Treasury is still over 4%. That's the real cost of capital, right? For any of your clients that have going out and shopping for mortgages, they're like, hey, we've had these 6 rate cuts. Why is my mortgage rate still 6% or higher? That's because everything's benchmarked off of the 10-year Treasury, not the shorter end of the curve. So once the 10-year gets below 4 on a sustainable basis, even more energy goes into these cyclically value names where we should see more lending benefiting the financials, but also that lending is going to the construction companies that are building out data centers, utilities, and all of that kind of stuff as well. So really kind of all of those things coming together as a thesis for us. That's where we think that there are better valuations, but also still strong growth metrics as we look at the last half of the year.
Absolutely. Makes complete sense.
Do you have any thoughts on everything that you just described, interest rate cuts, et cetera? What does the bond market look like in 2026?
Yeah, I mean, it's one of those things. The surprising part is GDP is over 5 and people are still worried about growth. And that's where I think the biggest disconnect is. Even the Federal Reserve itself in its December, summary economic projections, we're going to get the minutes from that meeting later today. But in their SEP, they have GDP pegged at 2.2% for this year. We're already double that at this moment in time. And so typically what happens is when we start to see more confidence in that growth number, that's when the long end of the yield curve comes down. And we think that just has to take a little bit of time. When it comes to the bond market, Europe has already lowered rates substantially faster than we have. Where else are you going to go and get basically a AAA rated bond that's paying you 4% for 10 years? That risk-free rate just doesn't exist anywhere else. Yes, you can find some higher yielding stuff that's out there. Even if that number goes down to 3.5%, there's still going to be buyers for that paper because it's such high quality, right? So depending on where you want to land in your own risk management, there's stuff out there. And the stuff I really worry about are these private credit offerings at 10, 11, 12%, where you probably still have Party City paper that lives in there and they went bankrupt 6 months ago, right? So those are the things I worry about. in terms of the spectrum of quality, I think you'll start to see some really big companies issue debt more than stock because there's going to be an appetite for that. Again, that's better. That's better for the bond market. There's higher quality paper. It's competitive, so that should bring, some of the Treasury yields down as corporate spreads get to be a little bit better.
Love it. Great. Nick, you got any questions going on in your mind, brother?
Yeah, just one. We've discussed value versus growth a lot so far. How do you guys feel about international versus the US? I know international's been on a tear recently. How are you guys feeling about that?
Yeah, there's definitely opportunities out there, with one caveat. Understand that if you're looking at the balance of developed markets, which is mainly Western Europe, that growth rate in revenue is deficit spending. So it just keep in mind that there's a certain limiting factor out there in, again, how fast or how much revenues will grow for some of these companies, but it's in the same cyclically value sectors that we're seeing, right? The defense spending is going to benefit, the guys that build tanks and stuff like that, right? Infrastructure is going to be another model as you start to see that they need to be more energy independent, things of that nature. So those are the sectors that I would really want to be involved in internationally. And then you can always pick and choose along how comfortable you are in emerging markets where there could be, some developments and pockets of growth, but you're always, kind of taking on a little bit more risk when you do that. So it's always know what you own, know why you own it when it comes to that kind of stuff.
Definitely.
Love it. Well, have we had I don't have insight into questions coming through from folks that have joined the call.
You can raise your hand or you can type it in the chat box.
All right.
It's like we got Richard raising his hand. I don't know that you're going to be able to speak on the call, Richard. If you want to type it out, or I got your text message. If you want to text it to me, that works as well. I'll read it out for you.
I just allowed your mic is hot if you want to come off mute.
All right.
Thanks for doing that. Thank you, Brian. I enjoyed your presentation. And thanks, Revisor, for putting this together. Quick question. Any thoughts on these LLMs, these large language models, and China specifically versus the United States? I mean, you've got a whole bunch of that whole race that's going on. I mean, obviously, you've got Grok with Elon. You've got Anthropic, Anthropic's got Claude. You got OpenAI. And then you've got China's got some really advanced models out there, right? DeepSeek, obviously. And then I think Alibaba's got Qwen. So any thoughts on that race and what you see, China versus US in terms of where they are in development and how that can affect the equities?
Yeah, it's always the guardrails, right? I think what you have here in the US and in Western markets is more safety controls. The big thing about DeepSeek and how they were able to come out and say, look, we could do this, 3 times more efficiently and effectively and achieve the same result, is they're not going out 24 decimal points the way that Gemini, ChatGPT, Grok are. They're only using 8. Right. So in their large language model, they're only solving to the 8th decimal point where everybody else is going 3 times longer, which is why it takes 3 times more energy in the compute. Right. So there's a dynamic there of, what are the appropriate safety guardrails? Can we build enough trust in a model that's only using 1/3 of the available computing power that everybody else is? Right. So there's going to be a competitive backdrop to this, and the results are going to have to be clear and convincing to say that DeepSeek is just as reliable as everybody else, only using 1/3 of the spectrum. So I think that's going to have to be something that the overall marketplace itself decides. Think of it as a generic alternative to AI because it will be cheaper because it does less, right? So it will come down to what we believe is the adoption rate of any of these large language models dominating one versus another. And right now, you have ChatGPT as the leader in the clubhouse, but all they can do is lose market share, and they are. Claude is coming up. Gemini is coming up. There's a real competition out there. I would say that DeepSeek is still on the fringe, along with some of the other Chinese bots that are out there, simply because of those safety guardrails that we don't really have a ton of trust in coming from that part of the world. Doesn't mean they aren't good, doesn't mean they won't compete, right? It's just the question of, are they really following all of the safety guidelines that we are at the same time?
Okay, thanks for explaining that distinction. Appreciate it.
Absolutely.
You have any other questions popped up
Great
from?
question, Richard. Yeah, I've got one. Oh, perfect. We'll go with that one. There we go. Noah Myers, he's asking, as we introduce your portfolios to our clients, what do you see as the most misunderstood aspect of your investment philosophy, and how can we help communicate that more clearly to clients in real-world conversations?
Yeah, I would say the biggest thing that we don't do at Zacks is we don't buy memes or themes, right? We are not a thematic investor, and we also are not the type of portfolio managers that go visit factory floors, right? If we have a position in Tesla, it's because they earn their spot by showing us that they have the propensity to continue to grow revenue. That revenue is going to grow profitably, and as a result, their stock price will go up. We're not going to go kick the tires and visit these CEOs. We're not going to go to investor day meetings. You have to show us in the actual math that your balance sheet is higher quality than your peers and that you have the road to more profitability.
I like it. So don't look for memes and themes. Not going to be there. If you want some solid risk-adjusted results, here we go. And by the way, advisors, we've got some great pieces just on, morning, you've got some SMA strategies that are, top, 5% in their space, and just some really great results. So I think the proof's in the pudding, as they say. Absolutely. Any other questions that came up?
Yeah, I do have one. This one's coming from an advisor. They sent a direct message to me. We touched on it a little bit earlier, but how do you think a new Fed chair might affect the equity and bond markets?
Well, we know who it is. We have a name to put in that place, right? Kevin Warsh, a very experienced name who's been on the Federal Reserve himself before, understands the system and the program, but has some pretty key differences in how the Fed should operate. Kevin Warsh is known to be more hawkish than most, so that doesn't necessarily translate to we're going to get 4 more rate cuts like the market believes that we are right now. And I would say that that's probably not the most important factor. Again, the most important thing to the markets and the economy is to get the long end of the yield curve down more. So if we got the 10-year down to 3.5% from where it's been at 4.1 to 4.2 over the last month or so, that's more meaningful in the immediate growth of the economy than 4 more rate cuts on the short end of the curve, right? So I think that is going to be something that he has to address, building the confidence that the growth is real, that it's sustainable, and that they can make progress towards rationalizing some of the deficit spending and the imbalance in terms of the deficit and where it's at. I think those two things become more important than the actual nominal rate on the short end of the curve coming down.
Absolutely. Great answer. Perfect. Well, I have a quick follow-up on that one. I don't have anything else. So with that, focusing on further out along the yield curve, I know that Warsh is a little bit, he's not a big fan of QE and continuing to expand the Fed's balance sheet. So with that tying into the long-term yields, how do you think that's going to impact markets?
Well, in the moment, let's just call it what it is, right? When you're in a state of quantitative easing, that means that the Federal Reserve is buying treasuries itself. By getting the bonds onto the balance sheet of the Federal Reserve, they're giving cash to the Treasury, right? So that's liquidity that goes back into the system. There's plenty of liquidity. Last I checked, there's something like $7.2 trillion sitting in money market accounts. If you combine commercial and retail accounts, that's plenty of liquidity. The long-term average is half that, 3.5 trillion. We've got 7 sitting out there on the sidelines right now. So by drying up the well, a certain extent is not necessarily a bad thing. Again, it might help force that long end of the curve down by drying up some of that excess liquidity that's just been lingering out there. I think that's probably going to be the first push that we would see from Warsh as Fed chair.
Great. Perfect. All right, let's see here. Let's see any additional questions right now. anyone, feel free to drop them in the chat. Meantime, we can keep talking here. So earlier we were talking about some anomalies. Yeah, you mentioned one of the people you work with, Zacks, I believe. He liked to mention these anomalies that we're seeing with certain names that have strong balance sheets, strong fundamentals, but maybe are a little bit mispriced right now. Where do you guys see opportunity there?
I think that, some of these names that we've been talking about still have room to run, even though John Deere and Caterpillar have had such a strong start to the year. When you look at the backlog of orders that they have and the fact that they're participating in AI as well, they're helping produce products more efficiently, right? And when it comes to their own production line, but they're also integrating AI into the usability of these giant machines to make them more productive on the back end as well. So there's definitely still more energy there. Where I want to look also is getting it a little bit more intricate into the actual build out phase, right? There's a couple of mid cap names that have come out in the construction space that have done incredibly well that probably still have more room to run as well. I'm talking about names like MCore or Amphenol. These are companies that work in really intricate and complicated wiring harnesses. MCore does it in the old school copper wiring. Amphenol does it using fiber optics. So based on how you're building data centers, they have to either be air cooled or liquid cooled. In case you don't know, water doesn't work well with copper, especially when there's electricity on it. So the fiber optic side of it really does have, I think, some strong legs, if you will, when it comes to those liquid cooled systems, especially the highest end ones that are coming out of NVIDIA's production line right now. So there's lots of pockets of real high energy still out there. It's just that the AI momentum has capped out at a point where it's starting to become more of a concern. That doesn't mean there aren't good ideas. There are. They're just not living in, I think, the same places that people thought they were just in the technology sector.
I like it.
Very good. Well, I guess we got what? We're 5 minutes. We got 5 minutes left. I don't know if any other questions have come through or not, but we can always it's been a great call. So we can always jump off a couple minutes early if we don't have any other questions. This has been a very, very enlightening conversation. Let's see, Richard. It looks like Richard just sent another question in through the chat.
Yep, we got it right here. And it's loading. All right, perfect. Brian, you mentioned that free cash flow is key to your methodology for evaluating growth equities. Are there any specific ratios or indicators that you all prefer?
Yeah, I think, on a nominal basis, obviously positive growth is what you're looking for. When you look at the Mag 7 over the last 10 years, when you look at something like Amazon, where probably 4 of the last 10 years, they've actually had negative free cash flow. And that's because Amazon got to where it is by reinvesting all of its revenue betting on itself, right? That's how they get to being a book retailer to the internet of everything, right? So that's fine. We understand that. And that's a very expansive thing to do with top line revenue. But if you're not at some point keeping some of that cash on hand to drive to your earnings profile, this is the moment where investors are going to start to ask questions. Okay, great. You're going to spend $200 billion this year in revenue. When does that come back? And when is it actually profitable? So sometimes on the scale of something like that, it becomes just a nominal positive versus negative. But inside that same hyperscaler conversation, you look at Microsoft and their free cash flow has just been steadily climbing. They're financing their same $200 billion in spending with the Azure cloud business. It's starting to generate reliably 40 to 50 billion per quarter, which is 200 billion per year. So it's not taking away from its free cash flow. So you have both rates right there. One, the nominal rate, and then the second is its peer group rate, looking side by side, people that are in the same business, how do they compare with each other? So what do I want to do? I probably want to own more Microsoft than Amazon using that metric.
Okay. Love it. Great. Richard says, thanks, Brian.
Well, it's certainly our pleasure. In our last moment here, we really do want to reiterate, it's obviously a pleasure for us to partner with you guys, and we want to be here as a resource. Hopefully, James and I have done a good job of demonstrating that we've got a pretty full grasp on what we're trying to accomplish here. And if we can help in any way, that means if you have questions about what's going on in the broader market, We don't do fixed income, but we obviously have an opinion. We talked a lot about bonds here. We're happy to share what we're seeing, thinking, and feeling about it. When it comes to publicly traded names, you're not going to find anybody better than us, and we're happy to participate in the conversation. You're probably never going to see a Zacks TV commercial, but we do want to be involved in your business. We want to help you partner with your clients. We want to be a resource to help you answer tough questions. That's what we're here to do.
Love it. Well, we greatly appreciate y'all, Brian and James. Thank you both for being on. This has been phenomenal. We're not just saying it. We are legitimately excited, stoked to have you on our platform. Huge milestone, super excited. And Ethan and Nick, thank you as well. And fellow advisors, thank you for popping on and listening today. And reach out with questions, and we can get you, we can get Zacks portfolios executed for your clients whenever you're ready. Just let us know. All right. Thanks, everyone.
Thank
Enjoy
you.
the rest of the day.
Thanks, everyone.
Bye,
Bye.
everybody.
Thanks, everyone.